Hello, this is YAZEED, and today I'm gonna talk about the MXIM versus CDW. Maxim Integrated Products and Company is an American company that's involved in the manufacturing and selling of linear and mixed signal integrated circuits. CDW Corporation is a provider of integrated information technology solutions. The company operates under two major segments: corporate segment and public segment. Liquidity analysis. Current ratio. From the table above, Maxim's current ratio have been above 4.00 over the last 5 years. This implies that the company has been in a position to pay its current liabilities over 4 times whenever due. The figure above indicates that Maxim has been maintaining very high liquidity compared to the competitor CDW Corp, although its current ratio have been characterized by fluctuations. Quick ratio. The quick ratio for Maxim Integrated Products and Company has been maintained at values above 3.5 over the last 5 years. Based on a cross-sectional analysis, the competitor's quick ratio may have been lower throughout the 5 years, but on absolute terms, its liquidity has been good. Leverage analysis. Debt ratio. From the table above, Maxim has been increasing debt financing for its assets over the last 5 years. The company's debt ratio was initially at 0.46 in 2014, but 4 years later, the ratio was 0.51 in 2018. From the figure above, Maxim Integrated Products and Company has been financing a smaller proportion of its assets using debt compared to CDW Corporate. The competitor has been financing more than 80% of its assets using borrowed funds. Debt to equity ratio. The debt to equity ratio for Maxim has been above 1.00 over the last 4 years, between 2015 and 2018. This suggests that the company's capital structure has been made of slightly more debt than equity. This trend has adverse implications in terms of increased risk exposure for the company. On the other hand, the competitor's debt to equity ratio has been increasing persistently over the last 5 years. The ratio was 5.51 in 2014 and 6.35 in 2018. Therefore, Maxim has been using less debt in relation to equity compared to its competitor. Long-term debt to equity ratio. The long-term debt to equity ratio for Maxim has been increasing from 0.44 in 2014 to 0.54 in 2018. However, CDW Corporation's long-term debt to equity has been way very higher compared to Maxim Integrated Products and Company. Therefore, the competitor has been highly leveraged and hence it has been exposed to very high risk. Management efficiency analysis. Total assets turnover. From the table above, the total asset turnover ratio has been slightly fluctuating between 0.56 and 0.52. This means the company has not been effective enough to maintain higher turnovers. From the figure above, the total assets turnover ratio for the competitor CDW Corporation has been very high over the last 5 years compared to Maxim Integrated Products and Company. This means the competitor has been managing its assets more eventually to generate relatively higher earnings. Accounts receivable turnover ratio. The accounts receivable turnover ratio for CDW Corporation has been slightly dropping over the last 5 years, and from 70.5 times in 2014 to 575 times in 2018. The trend suggests that the competitors' efficiency in collecting payments from debtors has been deteriorating. On average, MAXIM integrated products Inc.'s account receivables turnover has been higher compared to CDW Corporation. Therefore, the former has been more efficient in terms of account receivables management. Inventory turnover ratio. The inventory turnover ratio for MAXIM has been on a downward trend from 2015 at 368 times to 3.08 in 2018. This means the company has been converting its inventory to revenue fewer times compared to the previous years. On the other hand, the inventory for the competitor has been on a very slight decline over the last 5 years. However, on average, CDW Corporation has been selling its inventory way more times compared to MAXIM integrated products in company. Average age inventory. The average age of inventory for MAXIM has been increasing between 2015 at 99 days and 2018 at 118 days. This trend indicates that the company's inventory has been moving at a very slow rate compared to the previous periods. The implications of this trend are high costs of storing slow-moving inventory and other costs related to Westgate. The competitor has been selling its inventory in over 8 times fewer days compared to MAXIM. The competitor has therefore been managing its inventory more efficiently. Inventory to net working capital. The inventory to net working capital for MAXIM integrated products in company has been fluctuating over the last 5 years. On average, the competitor's inventory to net working capital has been relatively higher compared to MAXIM. Thus, the net working capital of the latter has been more liquid, that it has been composed of fewer investors. Inventories. Fixed assets turnover ratio. The fixed asset turnover ratio for MAXIM integrated products has been rising precisely from as low as 2.11 in 2014 to as high as 4.00 in 2019. This trend implies that the company has been utilizing its fixed assets quite efficiently. However, the competitor's fixed assets turnover ratio has been more than 20 times higher than MAXIM's. Therefore, CDW Corporation has been managing its fixed assets more efficiently. Profit analysis. From the table above, MAXIM Integrated Products Inc.'s total profit margin have been increasing rapidly from 55.13% in 2014 to 64.84% in 2018. The trend has been good for the company. What it suggests is that MAXIM has been recording the cost of goods after each year. The figure above indicates that MAXIM has been generating higher gross margins compared to its competitors over the 5 years, hence its ability to create earnings has been higher. Operating profit margin. Just like the total profit margin, the operating profit margin has also been on an upward trend. This implies that the company's operating expenses have been under control and hence could not affect the trend in operating margins significantly. The operating margin of the competitor has been very low compared to MAXIM. Net profit margin. Just like the total profit margin and operating profit margin for MAXIM, its net margin has been increasing persistently from 8.93% in 2014 to 52.56% in 2018. The net profit margin for the competitor has been more than 4 times lower than MAXIM integrated products and company. Return on investment. The return on investment for MAXIM has been increasing over the entire period from 11.13 in 2014 to 22.34 in 2019. This means the company has been making the most out of the money invested in the company from various sources. The return on investments for the competitor has been lower over the entire period due to the fact that its net profit margins have been lower too. Basic earnings power. The basic earning power for MAXIM integrated products and company has been on an upward trend over the entire period. This means the company has been moving towards maximum potential of generating earnings. The competitor's basic earning power has been increasing, but on average has been relatively lower than MAXIM. Growth ratios. Prices per earnings ratio. MAXIM integrated products and companies' price per earnings ratio has been dropping over the last 5 years. This means even though the company has been generating very high net profit every year, its relative market value has been on decline. From the figure above, the value of competitors has been more stable compared to MAXIM, whose stock's value has been dropping. Cash flow per share. The cash flow per share for MAXIM has been increasing over the last 5 years. This suggests that the company's financial strength has been improving over time. On the other hand, the cash flow per share for the competitor has been increasing. On average, the cash flow per share for CDW Corporation has been higher than MAXIM integrated products and companies. For this reason, the competitor's financial strength has been relatively higher. Dividend payout. The dividend payout for MAXIM has been dropping from as high as 1.58 in 2014 to as low as 0.62 in 2018. The decline in dividend has been on a period when the net earnings of the company had been increasing, meaning the company has been adopting a residual dividend policy. On the other hand, CDW Corporation dividend payout has been increasing persistently, although it has been lower compared to MAXIM integrated products and company. Conclusion. MAXIM integrated products and company financial performance has been outstanding both over the last 5 years and relative to competitors. The company's liquidity has been very high, while its leverage has been relatively healthy. As pointed out earlier, the company has been using less debt financing in its capital structure as well as in financing its assets compared to its rivals. Therefore, the company has been facing relatively lower financial risk. MAXIM has also been exceptional in terms of its profitability, beating its competitors in regards to total profit margins, operating profit margins, and net profit margins. The company's efficiency has been higher in terms of management of assets, although its inventory management has been worrying. Lastly, Even with all the outstanding performance and high profits, the market value and financial strength of the company have not been convincing. Thank you so much, guys, for listening.